Hi, everybody. Welcome to the Altech Chemicals webinar. Sorry for the wait, but we're waiting for another 3-4 minutes because software needs to be downloaded to join the webinar. Just wanted to let you all know. Okay, let's go ahead and start then. We have the Managing Director of Altech Chemicals, Iggy Tan here. I won't take more. I will just hand it over to him. Go ahead, Iggy.
Good morning, everyone, and it's actually afternoon here in Australia. Welcome to the Altech Chemicals webinar. I'll be going through the presentation today, and we'll take questions at the end of the presentation. Let's click through the slides. Altech Chemicals is an Australian company. It's listed on the Australian Stock Exchange, as well as the Frankfurt Stock Exchange. And our vision is to be one of the largest producers of high purity alumina with a 4,500 tons per annum HPA plant in Malaysia. The interesting thing about high purity alumina is that it forms sapphire gemstone in the Earth's crust. So a bit like carbon forms diamonds, alumina forms sapphire. And the only reason that the sapphire is a blue color is because of impurities in the alumina, like iron and chromium, that creates that blue in the sapphire. Now today, if you want to make synthetic sapphire for your watch face, you want it crystal clear. You don't want any blue tinge with it. So you actually have to start with high purity alumina to make synthetic sapphire. Sapphire is nearly as hard as diamonds. It has a hardness of 9 compared to 10 for diamonds. The product that we intend to produce has a purity of 99.99% purity, or 4N purity. Now, how does that compare to smelter grade alumina that Alcoa and Roussel produce around the world? That's about 99.5% purity. It has a lot of impurities, mainly sodium, because they use sodium hydroxide as part of the Bayer process. And the sodium gets locked into the crystal structure, is very difficult to remove, and certainly you can't use it to make synthetic sapphire. The purity is not high enough. The product that we intend to produce has a price of between 27 to 40,000 US dollars a ton. The price is exponential in purity, so smelter grade alumina might be worth $400. You add another 9, making 3 nines, it's worth 6,000 to 9,000 US dollars a ton. If you add another 9, it's worth 27 to 40,000 US dollars a ton. The two main industries that are driving our growth is the LED industry as well as the lithium battery industry. Now, I'll just turn off my camera for a while and then come back on later. But the first industry is basically LEDs. Now, every LED is basically a semiconductor. Now, in order to make a semiconductor, you need a wafer substrate, and they use sapphire wafer substrates. So every LED has a sapphire wafer substrate, and in order to make a sapphire wafer substrate, people buy high purity alumina, they stick it in the furnace at 2000 degrees, they heat it up, and it slowly cools over 21 days to form a single crystal of sapphire. So the sapphire industry for the LED is a fast-growing industry. It's growing at about 16% year on year. Now, as you can see on the screen there, that's what a typical sapphire wafer looks like. This is from Osram, a German LED manufacturer. And on these wafers, they add chemicals, and they add electronics, and that forms the basis of every LED. There you can see an LED being constructed. Now, the reason they're so popular around the world is because it uses 1/6 the amount of electricity than normal globes. So we see massive LED expansions around the world. In fact, Osram just built a $500 million plant in Malaysia. Companies like Philips, Sanan, General Electric are all expanding in the LED sector. I'll go back to the other industry that's driving the growth is in the lithium battery industry. So as you heard of the Samsung Galaxy battery fires, when a lithium battery catches a light is when the positive and negative terminal touch. You get a short and you get a thermal runaway. So every lithium battery has a separator between the positive and negative terminal. It keeps them from touching, and it allows the lithium ions to go back and forth. Now, they are now using high purity alumina to coat these separators in order to give them battery safety, because these batteries are getting hotter and hotter as the energy density has been increased. As you can see from the screen there, these separators are manufactured worldwide. They're big Japanese separator manufacturers, and they're now spraying high purity alumina on these separators to give them increased battery safety. So now I want to talk about why they're using high purity alumina in lithium batteries. This graph shows the price of batteries coming down, the cost of batteries, which is the blue bars, are coming down, and the reason for that is the energy density is going up. So they're packing a lot more energy density in a fixed volume. And in order to achieve the energy density, the cathode material of these batteries are evolving from lithium iron phosphate to lithium manganese to lithium cobalt to lithium nickel and so on. So that's why there's a bit of a scramble for cobalt and nickel sources for these batteries. Now, the consequence of the increased energy density is that they are now operating at higher temperatures. And I'm sure if you've left your phone on, you sometimes feel how hot that phone gets. Imagine in an electric vehicle where there's a lot of energy density in the batteries. This slide just shows you a typical polymer separator. It's made of polypropylene and polyethylene. It handles up to 100 degrees and then it starts to shrink. And now, when these separators shrink, it allows the positive and negative terminal to get in contact, and that's where you get a battery fire. They find that if they coat these separators with high purity alumina, that the membranes can handle up to 200 degrees. So consequently, a lot of battery manufacturers or separator manufacturers are incorporating high purity alumina. Now, this is a Japanese company called WScope. They manufacture separators for the lithium battery industry. In Q1 this year, they reported that 40% of their separators are coated with high purity alumina, whereas 12 months ago, only 11% was coated with high purity alumina. So you can see the rapid penetration rate of high purity alumina in the lithium battery sector. We see massive expansions around the world, where one of the biggest separator manufacturers is Asahi Kasei, and they've just built a $268 million plant, and many trains coming on to meet the lithium battery industry. The high purity alumina industry is about 25 to 30,000 tons per annum. It's not a large volume market, but it's a high value market, and it's expected to climb to 86,000 tons per annum. So something like a 60,000 tons per annum increase over up to 2025. Now, this growth is driven both by the LED sector, because today 1 billion LED units are made every year. It's expected to climb to 4 billion by 2025. In the originally, about 2 or 3 years ago, we estimated that out of the 86,000 tons, 15,000 tons was going to come from the lithium battery sector. But recently, because of the penetration rate, other companies like Petra Capital and CRU Consulting have come out with very bullish numbers on the separator growth. So Petra forecasts 37,000 from the separator industry, CRU very bullish at 76,000. So we average all the forecasts and we say it's about 38,000 from the lithium battery industry. What's interesting is that it's only 1.6 kilograms of HPA is used in every electric vehicle in the separators, because there's a very tiny coating that they put on the separators. Now, what's the value of that? It's about $100 US a car. So it doesn't add a lot of cost to the electric vehicle, and yet it's critical for the safety of the electric vehicle. So it's a bit like lithium. It's not a lot of lithium in lithium batteries, but you need the lithium ions for the battery to perform. If we add the LEDs growth on top of that, the forecasts are around 62 for persistence. Petra forecasts 122,000, CRU about 92,000. So average around 92,000 tons of growth coming by 2025. What's interesting is that's 20 times the plan that we are going to build of growth coming even after we build our plan. So you can see that the demand side is very strong. And what's interesting is that none of the current producers or the current incumbents have announced any expansions today. And any new entrants is looking at about 4 to 5 years behind us to come online. So our view is that demand would certainly outstrip supply going forward. Let's look at the current producers of high purity alumina. They are chemical companies like Sumitomo Chemicals, Sasol, which is a South African company, Bukowski is a French company, Nippon Light, Hebei Pengda is a Chinese company. What you notice about the distribution is that it's quite fragmented. It's not controlled by the Chinese producers like in the rare earth industry. And typical of chemical companies, they tend to buy a feedstock in to produce a chemical or product. Altech Chemicals is different in that we're a mining chemical company. We tend to own the feedstock in the ground. Now, how do they produce high purity alumina today? As I mentioned to you before, the sodium content of the smelter grade alumina is too high to use. These producers can't use that material. They have to use aluminium metal. So they buy high purity aluminium metal powder. They dissolve it in alcohol, the hydrolyzer, and calcine it back to alumina. It's called the alkoxide process. Now, where does aluminium metal come from? If you think about where aluminium metal comes from, it comes from the bauxite industry. They make smelter grade alumina. They ship it around the world to the aluminium refineries, which add a lot of electricity and costs in the electrolysis process to make aluminium metal. These guys buy the aluminium metal and dissolve it back down to alumina. It sort of doesn't make sense because it already started as an alumina. Now, my question to you is that if you have technology that can actually bypass the aluminium metal stage, go straight from the ore to the alumina in one single step, will you be disruptive to the whole industry, and will you be the cheapest cost producer? So I think instinctively the answer is yes. It is a disruptive process that we have. We go straight from the ore to the alumina in one single step, but we don't start with bauxite. We start with kaolin. Now, as you know, kaolin is a very white material, and the reason it's white is because Mother Nature has done a lot of the work for us. It's leached a lot of the iron out of the deposit, and so actually kaolin today is used for its whiteness. It's used in paper whitening, cosmetics, in ceramics and porcelain. And if you look at the iron content of kaolin, around 0.4% iron, compared to bauxite that has 21% iron. So a lot of the impurities have been leached out. And that's our feedstock fundamentally for the alumina content. So if you look at the analysis there, we've got about 30% alumina and nearly about 60% silica, which is okay because we would filter that out in our process. This deposit is in Western Australia, about 130 kilometers inland from Perth, the capital city. We have nearly 250 years of mine life material, so plenty of feedstock material. The deposit itself, it's well advanced. We have mining approval, we have works approval, we have environmental approval, and as you can see the picture down the bottom there, it's quite a very soft clay, and so the mining is also very simple. In fact, we can mine 3 years of material in 2 months, put it onto the ROM pad, and we basically stop mining after that. We then switch to a loading operation, the picture at the top there, and basically we load the sea containers with kaolin, 22 tons. We shut the door and we then send that to Malaysia. We would ship that material through our Fremantle port to the port of Tanjung Palapas in Johor. Now, why did we decide to build the high purity alumina plant in Johor? Well, we looked at various locations, and it's important for us to be the lowest cost producer in the world. If you want to compete globally today, you have to be one of the biggest, and you have to be one of the lowest cost producers. So we selected Malaysia because very distinct advantages. Firstly, is operating costs. So instead of buying hydrochloric acid in Australia for $350 a ton, in Malaysia it's $130. Electricity, instead of 25 cents a kilowatt hour, electricity in Johor is 12 cents a kilowatt hour. Labor cost is cheaper. We have reticulated natural gas, etc. But the most important thing is we have access to the 17th largest sea container port in the world, which is about 30 kilometers away. That's where our kaolin comes in sea containers, and that's where our final high purity alumina product goes out in sea containers. The best part of being in Malaysia is that we will get a 10-year tax-free window, no corporate tax for 10 years. I make the comment there about no radioactive waste because there, if you are aware, there is a company called Linus that has some issues with their radioactive waste. We are purely a benign silica material that is sold to brickworks. The site itself is in the middle of a chemical park. We have natural gas and electricity reticulated to it. As you can see, we've started the site clearance. It's a 4-hectare site, and as you can see around us, we have many chemical operations. So we have all the facilities within the chemical park. This is the plant that we want to build, 4,500 tons per annum of high purity alumina. It's a German technology. It's high-tech technology in that it is 2 operators in the control room will control the whole plant. In the back end of the plant, there are robotics that pack the machine, packing machines which packed all the material. And it's a very sophisticated German technology plant. The process itself is quite simple. The first part of the process is to remove quartz. So 50% of the kaolin comes in as sand. So what we do is we slurry it up in a drum scrubber and we screen the sand out. So 50% comes out as sand. The next part of the process is to acid leach the kaolin. But before that, we have to heat it up to 700 degrees. It changes the crystal structure. So it's a bit like popcorn. As you heat it, the crystal structure opens up, and then it's ready for acid leach. Now, when you add acid to the kaolin, it dissolves the alumina into aluminum chloride, which is soluble. So it goes into solution. What's not soluble is the rest of the silica, which we then filter out, and that's our residue byproduct. The next part of the process is actually purification of the aluminum chloride, and that's even quite simple. We crystallize the aluminum chloride out of solution by bubbling hydrochloric acid gas. Aluminum chloride crystals come into the solution, and then we filter that out. Now, the way we purify it is actually quite simple. If you can imagine brown sugar has impurities in the crystal. If you dissolve that brown sugar into hot water, all the sugar dissolves and all the impurities stay in the solution. And as you crystallize the sugar becomes white. It leaves all the impurities in the solution. And essentially that's what we do. We take the aluminum chloride, we dissolve it in distilled water, we recrystallize it out of solution, filter it, and then we do it again. We redissolve it and recrystallize it. And we can get very pure aluminum chloride crystals. Now the next step is to actually heat it up to 700 degrees, which then converts the aluminum chloride to aluminum oxide, which is alumina. It generates hydrochloric acid gas, and we feed that into a German HCl recycling plant. So we clean the HCl gas up again and refeed it back into the process. Now, this is a process where your main reactants, like hydrochloric acid, can actually be recycled, because a lot of chemical process, acids eventually end up as a waste and has to be neutralized. So this again will bring the cost of production down and is a big advantage in the process. We heat it to 1250 degrees as alpha alumina, and we make 2 kinds of products. One's a bead for the LED industry, and one's a powder material for the lithium battery industry. Now the whole process looks something like this. If you actually search Google kaolin to alumina using hydrochloric acid, you will find that the technology actually came from the Swiss in the early 1900s. But before we get there, let's have a quick look at the plant itself that we propose to build in Malaysia. As we come in, this is the administration building and the process design process building. We come into the front end of the plant where the sea containers are unloaded. On the right side is the drum scrubber where we slurry up the kaolin and we screen out the quartz. So we are proceeding into the kaolin beneficiation plant. That's the kiln that we heat the kaolin to metakaolin. And now we are proceeding in the hydrochloric acid leach section of the plant. A lot of these tanks are fluoroplastic tanks, plastic tanks. We now come into the final HPA product. On the right-hand side, you can see one of the roasters. And then we go into the final end where there is the final packing of the material and so on. Now, as I mentioned, the technology or the chemistry comes from the Swiss. The US government and Alcoa developed the process in the early 80s, but the demand for HPA wasn't, there was no demand for HPA in the 80s because there wasn't LEDs or lithium batteries. Because of the demand today, Altech Chemicals applied this same chemistry to our Meckering deposit, and we found that it was very successful in making high purity alumina at the lowest costs, nearly a third of the current cost, of a very disruptive process. So if you think of us, think of maybe Airbnb or Uber or something. It's a very disruptive technology. We have a couple of patents to protect our technology, and we feel that any new entrants will have to get around those patents. The economics itself, the current price is around 40,000 US dollars a ton. Let's look at the current price today. The capital cost is around 298 million. The pre-tax NPV or discounted cash flow is a $1.1 billion project. The internal rate of return is 33%. The payback at its full rate is around 2.4 years. It generates around 133 million US dollars EBITDA or net cash from the operations at its full rate. And the production cost is around $10 a kilo or $10,000 a ton. So if you produce this material for $10,000 a ton, sell it for 40,000, the gross margin is close to 75%. So then the question is, why such a high gross margin? Where typically in the chemical industry, you'll be lucky to get a 15 to 20% gross margin. Well, the only reason is that we are disruptive. We are the first process in the world today to use kaolin as the feedstock. Persistent is a company that did assess where we are on the cost curve. They think we're about a third or half the cost of the current producers. Well, if you don't believe that, just think about the feedstock. We don't have to buy aluminium metal, very expensive aluminium metal. We own alumina in the ground for free. Basically, if you're in Australia and you own the tenements, you own the minerals. So we have access to alumina for free. Hydrochloric acid is also recycled in the process and refed into the plant. And finally, we're in a low-cost country like Malaysia. So you can understand that we would be the lowest cost producer. All our offtake is sold to Mitsubishi for 10 years. As you know, a lot of chemicals that go into Japan have to go through trading houses. They buy the materials and they sell it to their customers. So similarly, Mitsubishi will buy all our HPA product and distribute to their customer base in Korea, Taiwan, Japan. They have customers in the lithium battery industry. They have customers in the LED industry. They are interested in HPA because a lot of companies are looking for materials that feed the renewable energy sector or the lithium battery sector. And HPA, like lithium and graphite and rare earth, is just one of those important materials. The next risk in any project is execution risk. I read a recent article that out of 106 projects, 67% of those had capital cost blowouts. Now, the way we are going to manage this risk is we've teamed up with a very large German engineering group called SMS Group. Now, SMS turns over about 3 billion euros a year. They have about €1 billion cash in the bank. They're a private company, but they have about 16,000 employees. Now, the way we manage that risk is we've given them, or they will give us, a lump sum fixed price turnkey contract. So what that means is that the price is fixed. They will take the risk if there's any capital cost blowouts. They will take the risk if there's any delays on the project. So they will give us liquidated damages every day after 30 days if the project is late. But more importantly, they will build the plant and they will hand us the keys when the plant is performing at the throughput rate of 4,500 tons per annum and producing at the quality of what the Mitsubishi specification is. As you know, SMS is the third largest German group that accesses export credit finance. Number one is Airbus, number two is Siemens, and number three is SMS. Now, besides being the EPC contractor, we've said to SMS that we want you to have skin in the game as well. And consequently, they have committed to contribute 15 million US in equity, of which we have already received 4 million. So SMS is a very important partner for us going forward. This next slide tries to show that we're trying to under-promise and over-deliver during startup. And the way to do that, whilst we've done a lot of lab work, lab pilot plan work, etc., SMS also comes with a lot of experience because they have worked in the kaolin to alumina process for the last eight years in their testing and development of process. They've never got to commercial production with their companies they work for, but that's the reason they have teamed up with us. Now, the way we try to manage the risk of technology and startup is using very conservative assumptions. So, for example, most engineering companies would design the plant to 90% utilization. We design it down to 79%. So the plant has to be bigger because there's less hours of runtime. Instead of a 90% recovery that we have in the lab, labs are great, but there are very pristine conditions in the lab and you get very good recoveries. How do you factor that when you're in the plant? So we design the recovery that we assume the recovery is only 60%. And so now the plant has to be much more robust. Instead of a head grade of 34% alumina going into the plant, we only assume 30%. So suddenly now the plant has to be bigger to produce the same tons. And instead of a 2-year ramp up, we've gone for a 3-year ramp up. So what it says is that if things go well, this probably could do a 6,000 ton per annum output, whilst our stated capacity is only 4,500. We have now closed the senior debt funding from KfW IPEX Bank. As you know, it's a German government bank. The total senior debt is 190 million, of which 170 million is export credit finance. What does that mean? Well, because 50% of our plant are German equipment, even the EPC contractor is a German company, and consequently the German government can underwrite the project, and with that underwriting, we get a very low interest from KfW IPEX Bank. So our interest rate is around 3.5% for nearly 14 years. We are now working on the balance of funds. So there are 3 work streams that we're working. First one is the subordinate mezzanine debt. Because the project is so cash rich, we can put some more debt in there, which is subordinate to the senior loan. We've now received a term sheet for US 90 million, which is now proceeding into due diligence. So they've appointed technical due diligence consultants, and that's going through their DD process. We also receive a stream term sheet. That's essentially a royalty deal where you sell part of the royalty of the product in exchange for an upfront payment. That is also going through the due diligence and proceeding as well. The other two areas that we're working is the equity component. So most projects, you can't have 100% debt. Projects will probably have about 66 to 70% debt equity. So you have to find the equity component. And we're working on equity on both fronts. One is pure equity at the parent company level, and the other one is potentially a joint venture or sell down at the project level. So essentially they're both equity, but at different levels. And we are proceeding with those activities as well. So the status of funding to date, 190 million is now closed, 90 and the 60 is going through its DD process. The company itself, 4 years ago, we were about 6-7 million market cap. Today, we're about 80-90 million. We have good liquidity. We've built up a shareholder base from 600 people to 3,500 people. We have about 572 million shares on issue. Our two major shareholders are the Malawa Group, which is a Malaysian steel and insurance group. They're about 9% of the company. SMS is also about 8% of the company. And we have quite a few institutions as well on the company, and we're building growth in that. We recently raised 21 million in July, and we have started clearing the site and the stage 1 construction process. We've commenced the construction. What we realized is that if we wait for the debt to finish, it could take 5-6 months. And we also would have to do 5-6 months of foundation piling on site anyway. So we've decided to start the process and start the construction process. And the hope is that when the debt finally closes, we are well on the way in the construction process. We recently had the grand opening on the 8th of August, and that was opened by the Australian High Commissioner. And this is a bit about the grand opening that we had on the 8th of August. We also had the German ambassador attend, Ule Hermes from Germany, KfW, and SMS. Also, our offtake partner, Mitsubishi, attended. Okay, so that ends our presentation, and maybe we can open it up for any questions.
Thank you so much, Iggy. It was really good to hear you. So I have a lot of questions coming from the audience for you. So I am just going to ask them in chronological order, in the order that I got them. And please don't hesitate to use the chat function, which you will find on the bottom of your screen, to ask questions now as well. So I'm just going to start with the first one. We have a question that says, do we see a capital increase in the near future?
Capital increase as in the capital cost of the project, I assume. We are pretty confident that the capital cost that was provided by SMS is fixed, but it's been quite a while since we had that, so we may be open to some changes to steel pricing and FX variation. But at this stage, we are pretty confident the amount is fixed.
Okay.
I think the question, Iggy, and if I may jump in here real quick, also alludes to a private placement or financing in terms of issuance of equity.
Oh, well, there's certainly going to be a equity component. If you think about the project, it's nearly 300 million US in plant and equipment. There's also going to be financing costs on top of that. And generally, a lot of these projects, you're running at about a 70-30% debt equity. So there will be an equity component, but we haven't worked out what the final amount of that is, because there are certain things that we're working on. So for example, a joint venture. So if we sold a proportion of the project, then our equity component is reduced, and then from whatever we raise from that sale, that adds to the equity component as well. So at this stage, we haven't finalized that, because we've got to see what the mezzanine debt provider would want for debt service amounts and so on. So and that's why we haven't got you a final equity amount yet.
Okay. Our second question is, when do you expect the first production?
The construction period is about 2 years, and we would expect first product out by the beginning of 2021.
Okay, thank you. The next one is, what are the conditions for royalty for financing deals?
The stream term sheet is a royalty deal, is basically swapping a royalty component, so X% of future revenues in exchange for, the 60 million upfront. It is expensive, and it is something we're still considering, and we're going through that process of considering it, as well as them going through their due diligence as well.
Okay, thank you. Our next question is, with robust forecast demand of HVA, is Altech Chemicals looking into discussions for financing a second plant as soon as financing for the first plant is locked in?
To be honest, we are focused in getting the first plant. I know a lot of people are talking about second plants. Of course, when we get the first plant up and running, the product meets specification, there is demand, there's obviously every opportunity to use the same technology, copy and paste, and build another plant. Of course, that's the advantage, but you have to crawl before you can run. So the first focus is to get the first plant up and running.
Okay. Okay, our next question is, assuming successful close of finance in, say, early February 2019, why does the company need to raise another 30 million Australian dollars when we already have project momentum from the recent equity raise funding current stage 1 construction? Another raise will cause yet more major dilution, particularly in light of the recent share price fall.
Yeah, the recent share price fall is due to the junior end of the market. Since July, junior stocks have been down 30-40%. In the lithium stocks, it's been down 40-50%. And I guess we are linked to the lithium stocks as well, because our product goes to the lithium battery industry. So that's really the price, the share price, and you can't, that's the global effect on your share price. All you can concentrate is building the project and taking every step and ticking every box to fulfill that project. The market is what the market is. There will be further capital raising to support the equity side. It's not fully funded from the point of view of equity. There will be further equity to come. We haven't finalized what that equity amount is. So certainly another 30 million will keep the project going. I say to people about dilution, that it's just a fact of life. If you don't want any dilution, I say to people, just don't build a project at all. Dilution is part of that, and it's how you manage that. But in the end, the value of getting the project online is the ultimate return to shareholders. But we are aware of dilution, and in the end, whether you bring on a joint venture partner and sell part of the project, you've diluted either at the project level or the holding level.
Okay, thank you. The next one is, could you please comment on the recently announced process patent? Why is it just an innovation patent, and how is it different to the previously declined one? What is the impact of it being only an Australian one, given that Altech Chemicals wants to manufacture in Malaysia and sell in Southeast Asia?
Yeah, so the recent patent grant is an innovative patent. We have also other patents that are coming, expected to be granted soon, and that may be standard patents. The patent is an Australian patent, so the question is, does that protect your technology worldwide? The answer is essentially yes. You don't have to go and put a patent in every country and around the world. If you try to put a patent in Australia, you have to check that it is unique all around the world. It doesn't mean it's you can just do it in Australia. So to give you a good example, the iPhone, just because there's a US patent on iPhone, and there might not be one in Australia, you can't go and recreate the iPhone in Australia. The patent is worldwide. Obviously, some companies tend to lodge patents in different countries. They add a different level of security. We have a patent in also Malaysia pending, but we believe that we have sufficient grounds to protect our technology.
Okay, thank you. The next one is, are all piling and foundation costs part of the SMS fixed price plant cost?
That's right. So all the stage one costs is essentially part of the fixed price, 280 million US. So as we spend on that essentially that whole number comes down. Stage two construction, which we haven't, we're still working out on that, piling costs, and that is all part of the fixed price turnkey contract.
Okay.
So whatever we're spending in stage one, it's part of the 280 million.
Okay. The next one is, when will design costs cease? The next planned equity raise talks about funding more design.
So the engineering design goes at different levels. So when you get to the final design required, when you can place an order, that is called, people call it detail design or construction design. That's the next level of design where you get to the specifics and you can place orders with your suppliers. And some of that work is required for the suppliers to do the engineering design as well. So, and all that cost that we talk about in stage two is also part of the fixed price turnkey contract that they would have done as part of that contract anyway. We're just taking that sections out so that we can fund that and get the project moving at the same time as the financial close of the debt side.
Okay. Our last question will be, how much more capital outside of the $290 million planned cost is required to get us into production?
So I think we've made statements in previous announcement of the financing costs. Financing costs basically, so plant and equipment costs is 298 million. That's just the plant and equipment and the construction of the buildings on site. Now, you have to then add financing costs. What's financing costs? There are things like working capital. So you need an amount of money to recruit people and commission the plant for 6-9 months before your first product comes out and you get revenues. So that's called working capital. You have bank fees. You have Ole Hermes fees for the ECA cover. You have debt service coverage. So the bank says, just in case things go wrong, we want a certain amount of money put aside to be able to pay, start repaying your loan if something happens in the project. You have also contingency, which the bank may ask for an amount of contingency in case things go wrong, and you can use it to resolve the issues. So we haven't finalized all those financing costs, but we've said in previous announcements that projects like this could add another 30% of the capex in financing costs. So whilst we're looking at that, we haven't finalized it because the debt lender hasn't closed the debt and specified what they need on the debt service accounts. We're also looking at opportunities to maybe find a joint venture partner and so on. So there will be equity raisings along the way, and depending on how the final structure looks. So again, we can't say exactly what we need, but there will be equity raising along the way. And most projects has a 66% or 70% debt equity ratio. You have to match your equity with the amount of debt you have.
Okay, our very, very last question will be, does Altech Chemicals have an already building permit in Johor? If not, when do you expect to get that?
So we have now just about to lodge the final plans and application for the development order. That will go in the next couple of weeks, and then there's a period of time we'll get that, and however we can start doing some of the bulk earthworks and mobilization. So we hopefully by November, mid-November, there will be a lot more activities. We've recently finished the geotech work. We had to do extra drilling on the site to work out the ground conditions. SMS wanted that information to confirm the building design and the layout, which they have now completed. So we're looking probably around November to see the activity pick up on the site.
All right, thank you very much. Thank you, Iggy, for answering the questions as well. Any other questions, please email us. We will be happy to answer. And I think that's enough for Saturday morning. Thank you, everybody, for signing on. And one quick note is we will be at the Adal Metallmesse Precious Metals Summit in Munich on November 9th and 10th. And Iggy will be there as well, so you can come and meet him there. And the webinar is recorded, so we will upload it on our YouTube channel, and you can also watch it from there too. Thank you so much again, Iggy.
Thank you, everyone, for your time on a Saturday morning.
All right.
All right, all the best.